We had a mixed day in the market yesterday with the Mag 7 coming out on top, but today our focus is going to be on Amazon that reported their earnings after the market close, and when we take a look currently in the pre-market, they are down around 2%. So we're going to understand what was the issue with their earnings, which was overall fairly strong, and whether we should consider adding on this dip. Now, over the last year, they are up around 6%. Year to date, though, they're down double digit, negative 13. But over the last 10 years, longer term shareholders, massive outperformance of the S&P, up 777%. Trading towards the lower end of the 52-week range, we get one strong buy rating from Wall Street, a buy from Seeking Alpha, and as a reminder, on a forward valuation, the company does trade around the 30 to 31 mark. Now at a very high level, in terms of their earnings, we do see the one that does point out, the one that analysts didn't like to see, was that AWS Cloud was in fact a miss, and even though it was a substantially small number, that is something that they wanted to see increase, given that it has been in a downward trend, and we will cover that in today's episode, but this is purely just from a high level perspective. With their top line revenue up 9% from the same quarter last year, we do notice some small efficiencies to their gross profit, up 1 percentage point, the same to be said for their operating margin, and their fastest growing income stream, as we highlighted, AWS, up 17%, and we can highlight over the last 3 quarters it has been around the 19% point, so this is in fact a bit of a slowdown that we are noticing, not something Wall Street wanted to see, and this is something we have now seen for the 3rd successive quarter. Again, this is something that analysts did have better expectations for, and if we just compare them against Microsoft as well as Google in terms of the cloud revenue, we can see at least over the last few years they have been the company that has been growing at a slower rate. Just this quarter we noticed 17%, for Google we see 28%, and for Microsoft around 33%. So this is having some effect on the share price, although what we would ultimately say is when the markets do open, we wouldn't be surprised to see them recover any of these losses. And also do bear in mind they are the number one in this space, where they hold around 30% of the market share. Second place we have Microsoft at 21%, and then we have Alphabet at 12%. Now in terms of the actual numbers and understanding a bit more behind what Wall Street were disappointed about, we can see the title does give some of this away. They issued light guidance where they did point to tariffs as well as trade policies being some factors in these decisions, and remember again, this is something we have continued to see throughout the earnings season. Now if we get firstly straight into the numbers, we can see EPS, a very nice beat, 159, market anticipating 136. Revenue also a beat, even though marginal nonetheless, 155.67, forecasted 155, and AWS, one of the main reasons that the share price is down alongside the guidance, coming in marginally under 29.3, forecasted wanted to see 29.42, and we do get a small beat on the advertising. So overall, you could say on the top headline numbers, they have performed fairly well. And then when we get to the metrics for this upcoming quarter, we can see on the operating income perspective, they are anticipating 13 to 17.5 billion. Not only is that quite a wide net, but it is also down in fact from what analysts wanted to see at 17.64, and they expect revenue to come in around 159 to 164, as noted, a 7 to 11% increase. Analysts are expecting around 161. Now something we have covered quite significantly on the channel, especially during earnings, but tariffs, trade policies, they are causing a lot of uncertainty, a lot of fear, and in fact a drop in consumer confidence. And something we touched upon in yesterday's episode, we are seeing now a lot of recessionary fears, and that is why they're also saying their guidance can be subject to change, so don't read too much into it. Also worth pointing out for those that missed it, news from just a few days ago, Amazon were reported in fact to be adding an additional layer of costing breakdown when you were going to buy products on their sites, so it was transparent, the additional cost element of tariffs that were in play, not something that Trump and the administration liked. In fact, we do get a report here saying that he complained personally to Bezos, and that Amazon have now said they are going to scrap this idea. And we heard from the White House calling this a hostile and political act by Amazon. Now in terms of the upcoming 4 quarters, they do anticipate 3 of them to be growth, and over the last 4 they have got a 100% track record, outperforming analyst targets, And as always, for those that do like to look to the next full accounting period, they're trading on 2026 numbers at a forward P of 25.6. But we also want to highlight that on a forward valuation, this company is trading near the lowest it has for quite some time. Some could argue that as a severe undervaluation signal. Something that we also notice when we look at the EV to EBIT multiple, Amazon on historical data does look undervalued, but just because a company does look perhaps cheap doesn't necessarily mean it can't get any cheaper, it can't go any lower. And actually for the company, we do see a D on the valuation grading. That is ultimately because the sector does trade in fact a lot lower, meaning you're paying a 105% premium. But in respect to their 5-year average at 177, they're trading significantly lower at 83%. So in conclusion, no matter what valuation metric you are looking at today, Amazon trades much higher at a premium essentially to the overall sector, but they're trading at a substantial discount to the 5-year average. So 2 questions we try to answer in the episode. 1, is it worth the premium? Now we do believe the answer is yes, as we will come to show you. Second question, how much of a premium does it deserve? Something we'll get through in our own valuation process. And if we do look at their latest investor presentation, in fact from yesterday, their sales are up 10% from the same quarter last year. Their operating income in fact up 51%, and their bottom line net income 75%. So we are still seeing a lot of growth from the company. And when we look at some of the latest analysts and their forecasts, we have Morgan Stanley, who in fact reiterate their price target. They maintain it as overweight at a $250 target. We have Bank of America, who in fact lift their stock price target to $230, and they also maintain it as a current buy. And we have another analyst who in fact cut the price, but still fairly high, $245, and maintains the company as a buy. So overall, the analysts do still believe there is a lot of opportunity for growth on the company, at least on the share price for now. And in terms of institutions with 72% ownership, they've sold around 47 billion worth of shares over the last year, buying a lot more in comparison at 137 billion from the exact same time frame. And we also notice in Q1 latest data set, a lot more bullish than bearish, 8.7 billion worth of buying, 2.7 billion worth of selling. We can also highlight insider ownership with around 11%, 2.5 billion worth of sales over the last year. Most recent quarter, 470,000 worth of selling. Q1, 23 million. As always, we can show you full transparency who these insiders are. Bear in mind, we don't see it as a bearish signal. Many reasons why they sell personal and financial. Most recent one, 1st of April, the CEO in fact selling 2,500 shares, netting them $470,000. Again, information is here if you want to incorporate it into your own analysis. The other thing that we like to do is show you what super investors are doing, and currently it is one of the stocks with most investors holding. In fact, we can note 25 do have Amazon in their portfolio. However, what we would say is, although we haven't seen some of the larger super investors release their portfolio for the latest quarter, something we will see in the upcoming days and weeks, so make sure you're subscribed as we will highlight them for your attention. But for those that have started to trickle in, every single one has either sold their position or in fact starting to trim. Again, doesn't mean we should copy their trade, but always interesting to note what super investors are doing. And if we look to Q4 as well, we do get a very, very similar scenario. Many of them are in fact reducing their position. Now, we did say earlier it does deserve a premium to the overall sector. We're going to show you why. In terms of growth, A-, revenue year on year, 11%. Forward looking, 10%, that is well above the low single digit of the sector median, but actually they are growing their revenue slower than the last 5 years at 19 and 17% respectively, with the earnings per share expected to grow over the next 3 to 5 years, 20%, well above the sector at 11, but again lower than their 5-year at 31. In terms of profitability, looks strong at an A+, gross margin 49%, above the sector at 39, above their own 5-year at 44, bottom line 9.3%, above the sector again, above their own 5-year average. So not only is their revenue increasing, but they're also improving on their efficiencies, something we love to note, whilst also generating a lot more cash from operations, 116 billion than their 5-year average at 66 billion, and significantly above the SEC at 276 million. We can also highlight their performance against others in the industry. We have Alibaba, PDD Holdings, as well as some other very popular names within the same sector. Now over the last year, they're up although only 6%, making them one of the worst performers, at least over this period. When we expand to over the last 5 years, a bit of a better performance, up 66, but again sitting right in the middle. And if we zoom out to over the last 10 years, they are the second best, up 772, but remember, past performance not an indicator of the future. And we'll also highlight against the S&P, where they've actually underperformed at least over the last 12 months, up 6%, S&P up 12. Over the last 5 years, again, they have underperformed, up 66%, the S&P up 98. But over the last 10 years, we can see that is if you are a longer term shareholder, you would have massively outperformed, 777 versus 165. Question is, depending on your investment time horizon, will they be able to outperform? Something definitely worth noting. And we also just briefly, before we get into our valuation, want to cover the underlying metrics. Free cash flow, as always, over the earnings, which is susceptible to manipulation by management through accounting. Consistent increases over the longer term, something we do note more often than not, and expected a large jump to $4.41 over the next 12, with sales growth looking very strong, 9 of the last 10 years, double digit, including the most recent period, up 11%, and we can see their total sales a very large increase, in fact around 6 times from 2015 to 2024, but we should point out they have been diluting your position as a shareholder over the last 10 years. Now if you've been an investor over this period, you probably wouldn't mind, but again, something just to take note of. ROIC then, 10% or more, give us faith, management are able to effectively allocate their capital. Very inconsistent, 12% at least looking good in 2024, something to bear in mind, especially as this company does spend a lot of capex every single year, in fact anticipated 100 billion in FY25 in what they do believe is a once in a lifetime AI opportunity, so you want to ensure that whatever they're spending you do get a good return on. And then we move to the margins, where whilst it has been increasing over the last 10 years from 2% to 11%, ideally we would like to see this a little bit higher, but given that it has increased severely from the lows of 2022, perhaps we should expect this to continue into 2025, and the free cash flow straddling around that minimum 5% that we do want to see year on year. Then we get to the net debt to EBITDA correlating to the balance sheet strength. These are the number of years it would take them to pay off all of their debt net of cash on hand. Below 3 is what we want to see, 0.34 on a trailing 12 month, 0.3 over the next year. So this does look like balance sheet does look very strong, no worries whatsoever, at least for the time being. And always good to see their income statement. We do notice, as highlighted, top line has grown 6 times over the last 10 years, but we just very briefly want to make sure their bottom line income does in fact follow a fairly similar story, and the answer is, for the large part, yes, it has gone from 600 million in 2015 to now sitting at 60 billion, so a very rapid increase. Again, something just to keep an eye on. You always want your companies that you're invested in to increase both their top line as well as their bottom line net income. And then we flip to the balance sheet for a quick health check, total cash versus total debt, with their cash only increasing over the longer term, 20 billion in 2015, now sitting in the latest quarter at just over 100 billion, very large amount on their balance sheet. But as always, one number here in pure isolation won't give anything away, so we compare it to their total debt numerically and directionally, which has only been increasing over the last 10 years, 17.5 billion in 2015, now sitting at 155 billion, which is actually superior to their cash balance. Definitely something we would say just to keep an eye on, but as we saw earlier, net debt to EBITDA does look good for the time being. Now we also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to a recently released copy of severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, and you can grab another recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into our intrinsic value for the company, we get to $230 derived from the DCF model. We have the free cash flow year on year. Average growth is skewed, as we can note, negative to positive for a number of years. Moving forwards, we've gone 20%. That is at our lower end, as we can see, low, medium, and high, 20, 25, 30% respectively. And the numbers are, as we say, subjective, so you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Amazon or any others. But based on 20% and the discount rate, we get to the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and get to our intrinsic price, $230, indicating 24% upside. Now we'll also show you full transparency for those that believe it should be higher, 25%, 325, 75% upside, and at the 30%, we get to 454, 144, more than a double. Now, typically we do like to take through the median rate, but we want to be conservative at the 20%, which is lower than analyst expectations. And we're not just done there, because we always apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, a buy at $207, then we keep going till it's near the current trading price. And right now we see around a 20% MOS. Wall Street themselves, they have a price target, $254 on average. That in turn translates to 37% upside. As always though, give us your thoughts. Did you like their earnings? Are you happy? Do you believe a slowdown in the cloud revenue is something to worry about? And is this one you see as a buy, hold, or sell? Now I'll also show you, perhaps you believe 20% is too high. If you wanted to go lower at 15%, the intrinsic price would be $161. But if we take a medium rate from 15 to 20 and go around the 18%, you can see this would be valued around the $200 mark. And if you wanted to see the MOS based on that, you wouldn't be getting 10% just yet. That would sit around $180. As always though, give us your thoughts about Amazon. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.